Warren Buffett made a $500,000 public bet in 2008 that hedge funds couldn't beat a simple S&P 500 index fund over 10 years. He won. Every single hedge fund underperformed. Charlie Munger was even more blunt. Avoid private equity and hedge funds like the plague. Today, I'm revealing the exact investments Buffett and Munger warned you to avoid in 2026, and why ignoring this advice will cost you a fortune. Let's start with the biggest wealth destroyer: private equity and hedge funds. Munger didn't mince words. Avoid them like the plague. But why? Aren't these sophisticated investment vehicles for wealthy people? Here's what Buffett discovered. We have seen a number of proposals from private equity funds where the returns are not calculated in a way that I would term as honest. Translation: they're lying about their returns. And the data backs this up. A study published in the Oxford Academics Review of Financial Studies found that private equity underperformed the S&P 500 by 3% per year on average, and by 6% per year on an equal risk-adjusted basis. Think about that. After adjusting for risk, private equity, the supposedly sophisticated investment reserved for the wealthy, underperforms a simple index fund by 6% annually. But here's the real kicker. Private equity funds raise huge sums of money, from which managers and marketers skim off the top. It doesn't typically matter how badly they perform. The managers get paid regardless of your returns. That's not investing. That's a fee extraction scheme. And hedge funds? Same story. Buffett's famous 2008 bet proved it. Not a single hedge fund beat the S&P 500 index over 10 years. And investors paid millions in fees for that underperformance. Munger's warning extends beyond just performance. Private equity funds aren't regulated products. That means there's little recourse if someone absconds with the money. Bernie Madoff, $65 billion fraud. Private equity structure. No regulation. No protection. Next up, day trading and stock trading apps like Robinhood. Munger called Robinhood a gambling parlor masquerading as a respectable business. Buffett added, it's not encouraging people to buy a very, very, very low-cost index fund and hold it for 50 years. New investors are learning how to trade riskier options rather than being taught to let their investments grow over time. Here's the trap. These apps make trading feel free. No commissions. Easy interface. Gamified investing. But Munger warned, it's telling people they aren't paying commissions when the commissions are simply disguised in the trading. You're paying. You just don't see it. And more importantly, you're losing because experts warn that the ease of use of trading apps makes it easier for users to lose large sums of money fast. The data is brutal. Passive investing in index funds has been shown to outperform 92% of actively managed funds over the past 15 years. If professional fund managers with teams of analysts can't beat the index, what makes you think you can buy day trading on your phone? Here's Buffett and Munger's most fundamental rule. Stay within your circle of competence. Munger and Buffett both say the key to their success has been their ability to avoid making dumb decisions rather than making brilliant ones. And the dumbest decision? Investing in things you don't understand. Munger's approach: don't be dissuaded by complexity. Just because you don't understand an investment doesn't mean you should avoid it if ruin is your goal. That's sarcasm. If you don't understand it, don't buy it. This applies to complex derivatives, structured products, leveraged ETFs. Anything a salesperson tells you is too good to miss. Munger warned specifically about leverage. Using leverage, borrowing money to invest more heavily, can increase your risks significantly. And here's the pattern. Hold your losers when counter-evidence is strong, and even if your investment thesis is broken. No one likes to admit defeat. That's what not to do. When you're wrong, sell. Don't double down on stupidity. So if Buffett and Munger say avoid private equity, hedge funds, day trading, and complex investments, what should you do? Buffett's recommendation is stunningly simple. Consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin. That's it. That's the secret. Index funds hold every stock in the S&P 500, including Apple, Microsoft, and Google. Because this type of fund is highly diversified, it stays relatively constant and avoids the ups and downs of picking single stocks. Your 2026 action plan. Avoid private equity and hedge funds. They underperform by 6% annually on a risk-adjusted basis. Day trading and Robinhood-style apps. 92% of active traders underperform. Investments outside your circle of competence. Complexity is not your friend. Leverage, it magnifies losses, not just gains. Do this instead. Buy low-cost S&P 500 index funds. Hold for decades, not days. Practice what Munger called sit-tight investing. Owning just one of the rare enterprises that can deploy additional capital at high future returns, and sitting tight can deliver wealth almost beyond measure. Warren Buffett is worth $135 billion. He recommends index funds for everyone except professional investors. Charlie Munger died with over $2.5 billion using this exact approach. Stop trying to outsmart the market. Just avoid the mistakes that destroy 90% of investors. That's how you win in 2026. If you found this useful, hit the subscription button and notification bell.